Okay, ambitious video time. So, statement of cash flows is probably one of the topics on paper one that people get the most worried about. As in, it's just a long layout, it's a little bit complex. I love it, but I'm a bit of a geek, so that's fair enough that I would. But it is one that when it comes up, people get worried. It's nothing to say it won't come up in 2026, and clearly in subsequent years. Last came up in 2023. So I've got the layout that I use in class, which goes through everything, but just a couple things to discuss. When you're reading the question, be clear what is the examiner asking for. So in previous years, it's clearly stated a full layout is not required. That's the only time you should really not do a full layout, when it clearly says that. So if it says prepare or create a statement of cash flows under IAS 7, that means do the whole layout. A couple of years ago, it did this, but it then said, please include net cash flow from operating activities in your answer. That was just because it wanted it as known figure. And you just read those instructions clearly in any exam question. The instruction is telling you something and there's a figure attached to it, obviously, or a mark attached to it, should I say. So statement of cash flows, first step, read the question. Second thing to indicate that you probably are going to have to do the full layout is where you're given profit from operations, because profit from operations itself is quite a few marks in working it out. So if you're not given it, then there's a good chance it's not the full layout. So yeah, so top left, you've got the layout. You've got the start of the layout anyway. You've got the operating activity section, and it starts from profit operations. Now, if you look to the right of this, see if I can get a highlighted to work. You've got the profit from operations section here. So if you've not been given it, what you've got to be doing is calculating that profit from operations figure. So obviously, if you were given the income statement, you could get the profit from operations figure, or if you're just given it in the question. Otherwise, you're going to have to do a rework. So profit from operations, what we do is we look at our retained earnings at year end. So what was our retained earnings at year end, and compare it to the beginning. I don't think I'm going to highlight everything. It's going to slow me down too much. All things being equal, if you look at the difference between beginning and end, if nothing else changed, that would be the profit from operations. But as it's a limited company account, that's not necessarily the case. Now, what I would look at here is that firstly is what has been deducted from that profit from operations to get to the retained earnings figure. So one of those is dividends paid. We're not going to include dividends proposed, so we'll add back any dividends paid figures. Now, I've not listed it here, but once you add back the dividends paid, you get to the profit after tax figure. So then you know that you're going to have to deduct tax from that figure, so add back tax from that figure, because it gets deducted from that figure in the income statement. So we're going to add back the tax expense. That then gets you to the profit before tax. Now, before I get there, it's the tax expense figure, so the tax income statement figure, not the tax paid, which are two different things. We then add back finance costs. Interestingly there, we then add back finance costs on any debentures or loans, usually debentures when it's a limited company, and that gets you to the profit from operations, because profit before tax is after the deduction of those finance costs. So you can have 4 or 5 marks for calculating the profit from operations, nothing stopping that being an individual question in its own right. Then that gives you your starter line. So profit from operations, and then you're going to reconcile from profit from operations and why your cash figure at the end of the year is a little bit different. So we've got different adjustments. So we go to depreciation. Depreciation has been a deduction from profit, but it's non-cash. So therefore we add it back because it hasn't had a cash impact on the business, and we're looking at how much money we got in the bank. We then have profit or loss and disposal of PPE, so property, plant and equipment. And so what we're looking at here, profit or loss and disposal, is profit based firstly, so it's not cash flow. So we need to remove it. So profit increased, obviously, the profit from operations figure, so we're going to take it away. Loss decreased it, so we're going to add back to reduce the impact it had. The other issue with disposal of PPE, the first section is operating activities, so it's day-to-day activities within the business. So we wouldn't classify that as that, we'd classify it as investing. So 3 sections: operating day-to-day, investing money into non-current assets, or making a return from those non-current assets when we sell them. So that would be the proceeds, and we'll get to that in a moment, or any other investments we've got, such as dividends or interest received. We then have the financing activities, which is where we raise funds to purchase our non-current assets or just to grow as a business. So we've got to be able to classify. And so profit or loss and disposal, long-winded way of saying it. A disposal is an investing activity. Profit and loss is not cash flow, so we need to remove its impact. We then have these three sections, which are trade receivables, trade payables, and dividend. Sorry, and inventories. That's not taking dividends, which is not what I want. Those three sections are what we call the working capital impact. Sometimes they're only going to be 1 or 2 marks for getting them right. And if you look at this section in the top right, I'm just talking a little bit through that. So inventories. If inventories are going up, so we look at our SFP figures and we compare them carefully, check the years, don't get that the wrong way because that's crazy to lose a mark for that. So if inventories go up over the 2 years, so it's a higher value, that means the business has invested more in inventory. So inventory's gone up, we've invested more, which therefore means we have spent more money. So we're going to deduct that from the profit, so we've got a cash outflow. If inventories goes down, that means we're using up the inventory that we hold in stock. So we've got a cash benefit there. So we're going to add that back. So we're not replacing it. There's trade receivables. Trade receivables goes up. That means we're owed more money. And if we're owed more money, that means our trade receivables haven't paid us, which means there's going to be a reduction in cash flow. So we will deduct that from our reconciliation. Whereas if trade receivables goes down, that means more people have paid us. And therefore, that means we'd add that because if it's gone down, that means they paid us. That means we've got more cash flow. With trade payables, if that goes up, that means we owe more money. If we owe more money, that means we haven't paid it. So trade payables goes up, that means we've got more cash flow, and we will add it. Whereas if trade payables goes down, we owe less money, which means we must have paid our suppliers, which means we've had a cash outflow, which means we need to deduct it. So those three, being our working capital changes, are predominantly always on a statement of cash flows if you're doing an operating section. Dividends received, not often, but could be. So if we've received dividends, they're in the wrong place. Dividends received is an investing activity. So we're removing it from the operating and putting it into investing. So it's increased profit. It is a cash flow, but it needs to be investing. We then have that subheading, which is cash generated by operations. So that's the general cash we've operated by day-to-day activities. Then we have interest and tax, because we don't really call that a day-to-day activity, but it obviously is. They are costs related to our operating business, but they're just not really in our control. So separately recording them is logical. Interest paid is an important one. Interest paid often the same as finance costs. If you'd worked out the finance cost to work out the profit from operations, that's not usually, but often the only figure between the two. But it's interest paid. So if you did have an accrual, then there's a bit of an adjustment to be made there because the amount that you pay will be slightly different to the finance costs. So if you had an opening accrual, you'd be paying for that, so that will be added. But if you had a closing accrual, we haven't paid for it yet, so it's going to be moved on. And then obviously you can have the same adjustments for prepayments. It's just something to consider. Tax paid. If you're ever told by me, I'm obsessed with the tax T account. I think it's awesome. So tax paid is the bank figure. And so personally, and I'm just highlighting it here in my tax paid section, what I'd be looking at is doing a tax T account. So tax T account being a liability account. So we'd have an opening liability on the credit, closing liability, the carried down will be on the debit. Tax charge for the year is an income statement, so that'd be on the credit, so because it would be on the debit side of the income statement, and the balancing figure would be tax paid on the debit, and it would be tax paid on the debit because we're going to credit the bank. Credit would reduce the bank, so debit is the payment. So you might need to do a T account to work out tax paid, or sometimes for the tax expense. So yeah, that's important. And then we get our net cash from operating. So sometimes, and that's been a 14 marker just to do the net cash from operating activities because there's lots of adjustments that you could do. After that, we then go into investing activities and just what we've spent or what we've raised from investing in our company. So one of those is the purchase of PPE. So if we're looking at the purchase of PPE, any non-current assets we've purchased. So it could be just the difference between opening and closing cost balances. That would be fair. And so obviously if the cost has gone up by 50,000, we've spent 50,000 on assets. But we need to be careful there because we've got the difference. We've got any revaluations or disposals. We'd have to deduct any revaluations because the cost account has gone up by that revaluation and we've not spent any money on that. We would have to add back any disposals because our cost has gone down for a disposal and that's a balancing item in that account. So you could just do a little T account again to reflect that. It could be awkward if you've only got an opening and closing net book value for PPE, and then you'd have to make adjustments. So disposals have to be a net book value. Everything has to be like for like when you're adjusting it. But have a look at a purchase of PPE NBVT account. There's an option there. Receipts from sale of PPE. So like we said earlier, profit, loss and disposal needs to go here, but we need to look at the receipts, so the proceeds. How much money do we actually make from it, not whether we made a profit or loss. So if we've made a profit on disposal, that means we have raised more than the net book value. We add that onto the net book value. That's how much money we received. And if we made a loss, we would deduct it because we've got less money than we thought. So yeah, so proceeds from the sale of a property, plant or equipment, if I speak properly, would be useful. Dividends received, we just add, we've moved it from there, interest received as well. That gives us our net cash used in investing activity. So you could have that as a subsection, and working out the purchase of PPE might be the marks that would help to make it into a higher tariff question. Financing, not as much going on, but there's some interesting things. You've got to look at the loans, so check the differences. Additional loans, so if there was an increase in the loan account or the debenture account, that means you've got more money coming in, so that would be an addition. But if it's gone down, that would be a decrease, so you've had a repayment of the loan. So you could have a proceeds or you could have repayment. Share capital, look for the difference between opening and closing balances for both share capital and premium. And make sure to use the overall value of both for a share issue, because that's something that quite often people will miss. Now, if you do have a share issue, there's usually an increase in share capital and share premium, so that is the issue of share capital. If, however, share capital went up to the same amount that share premium went down, then that's likely to be a bonus issue, and there's no cash impact. They could do that to try and test you. Dividends paid, not dividends proposed, because dividends proposed haven't happened, so just be careful to look out for the correct dividend figure, and then add them all up, and you've got the subsection net cash from financing activities. Just a little note on the finance costs when you're calculating those. Just be careful on the months. If you've got a debenture, so the date from when it's issued. So if you issued a debenture the 1st of June, it's to the end of the year, it'll be 7 months because it's from the beginning of June. If it's repaid, it's up to the date that you repaid it that you have to pay interest. Look at finance costs because that's going to be really important. The last part of the statement of cash flows, you're going to have your opening cash and cash equivalents, so just the opening cash balances, make sure to check bank and overdraft. Net increase or decrease in cash and cash equivalents. So that's just the 3 sections we've just done added together. That at the opening balance will be your closing balance. So your way of testing is to look at the closing bank balance and seeing, yes, it's working. We actually have agreed to it. If it doesn't agree, you double check things. You don't scribble things out because there's lots of method. And if you follow the majority of the method that we've gone through here, you'd get a lot of marks. We've looked at the disposals. There's a little bit here about it, profit or loss and disposal if you're not giving it. So if we more than net book value, it's a profit. So yeah, you might have to calculate that. So if you give the net book value and the proceeds, so it could be that way rather than what I said a moment ago about the receipts, or if it's less than net book value, it's a loss. There's lots of things on this handout that just is my way of trying to represent it all. But just don't be overawed by the statement of cash flows. But look at the 3 sections, look at the adjustments, and just think: what is cash, what is profit? Because at the end of the day, we're looking at the difference between the 2. Okay, good luck.